Today we're going to talk about the iceberg. Many people say the iceberg is so important when you trading, but not too many people are actually able to demonstrate you how it works and how it can be applicable to you and me, average trader. Okay, now the definition of the iceberg is an iceberg. It is the order that is a very large to buy or to sell that is split later into several smaller limit orders. The term iceberg comes from the fact that only a small portion of the orders is visible on the order book or a heat map, similar to the tip of an iceberg. I'm going to give you two kind of the icebergs to think about because the iceberg clearly it is the order type. So they are detectable, those orders detectable by the order type on MBO data feeds. And when you see the MBO data feeds, there's a micro icebergs. There's so many of them in a like 2 or 3 minutes time frame. You can see like tens of them or even more. And it's used for the high frequency trading. It's great to use for high frequency trading. When you have like so many trades in a milliseconds, it's quite expensive to pay for the data feed to get the MBO data to detect them by the order type. About $120 or $150 or even higher a month. So there's not too many people actually use them. There is a lack of clear practical use of those icebergs that are detectable on the MBO data. If you go and search online like I did, I spent a few days even to find a real clear-cut, vivid example how those icebergs can be used. And this is the reason why I'm going to talk about the icebergs that are behavioral in nature, because we need to produce, the iceberg need to produce some kind of reaction that we can trade. Because if we can trade 10 ticks or more, what's the point for us to even talk about the icebergs? We will consider those icebergs that we actually can use and make money off. If we'll take a look at the regular chart, we couldn't detect the icebergs because we don't have the level 2 data feed to show us those passive orders. We're only seeing on this chart only orders by market, very aggressive orders. Now, if we switch it to the heat map, like what you're seeing right here, and this heat map from the bestorderflow.com, the HeatmapNT, that's specifically built for NinjaTrader, this heat map capable to show the passive sitting orders. And let me explain this chart for you, okay? That in a microcosmos, in a micro situation, what happens on this very chart? The price was flying down and hit this wall. Went a little bit lower, found no liquidity, and bounced it up. Oh, we can understand this bounce. And then the price went even lower. This is the lowest point of all of this range that sits over here. Now, after the price created the lowest point over here, it's created the highest point of this range. This is the highest point of this range. And it is inducement into the upper side. And then the price went even lower over here on this side. So telling, hey, I'm not actually going up. So then price actually made a little bit of accumulation, went higher. So those people who were shooting down, who were executing themselves with shorts, they actually boom by the margin call. This is the orders that were happening because of the margin call of this liquidity sitting right over here. This micro situation happens over here, but then price went up and somebody started to releasing their accumulation and making a large profit, and the price went lower. Interesting. Why it went lower? Because it want to create the point of liquidity, a lower low over here than the previous low over here. So now, when the price created lower low, now their liquidity start building over here, and the price went up. And then boom, we're seeing that it start building this range. What is the purpose of this range? You see, this is the highest point of this range. Okay, they took the liquidity from the left, of course, but this is the highest point of this range. This very range was created as a equal to this low, and this low about the same. So there's a lot of liquidity. We're sitting over here, and the price what? The price couldn't find liquidity right here. Right here. So it's created those lows to create the liquidity. Again, the price went down. Oh, no liquidity. No liquidity. No liquidity. No liquidity. So the price created those small lows. 1, 2, 3, 4, 5, whatever, 6 of them right there, because it want to accumulate or tell traders to put their orders in this area, or as a stops, or as the way to short it, whatever it is. So there's a bunch of liquidity sitting over here, here, and here. And why? Because we're seeing that this is the low, previous low, and now we created lower low, and definitely liquidity, if it was sitting over here, move it into this price zone. Now, after the price created liquidity, actually on both sides, on the upper side as well, it went boom and took the liquidity that it's created on the upper side. And it's a very classic move, taking liquidity on a one side, which is not the side that price will intended to go to, but on a wrong side, to say in the quotes, and then it went and grabbed liquidity on the left side. Very classic move. And after price went down very deeply over here and collected all of that liquidity, there's a no liquidity over here. The price created, is that a break of structure? Absolutely. It looks like a break of structure on other charts, but that was a manipulation block. Clearly, guys, this is a manipulation block, this one. The whole block was manipulation block, not just a few candles for manipulation or inducement, but the whole block, because price couldn't find liquidity lower. Now, when it couldn't find liquidity lower, what was the goal? Now, the goal was to collect all that liquidity that were sitting right at those tops. That's why price bounced up and start to collect all of that liquidity on a way up. And here's a practical takeaway out of these lessons. First, we can see the iceberg very clearly. This person want to show it to us, a visible part of the iceberg. And then we need to get ready for the other actions that happens when the price went into invisible limit orders that not even detectable. So the price actually visibly bounced over here, and it's a great point for us to enter into long. And on this chart, we can see that after this manipulation, after the visible part of the iceberg was played off on the battlefield, we went higher and then we returned back because price want to manipulate. So now that price build liquidity on that side, and it's difficult for us in a real time when the price is bouncing from that trend line or that channel to think what price is going to do next. But when we know that the channels only, the purpose for the channels is to get broken. And for us, we need to wait until the price sinks down into the false inducement and building this manipulation block. This is not even the manipulation candles. It's a whole manipulation block on a 1 second time frame. And then price will consider if it's already grabbed liquidity over here on that side, then it's already built liquidity on the upper side, then the price will most likely will go and grab that liquidity. And our best entry is, let's say, if we want to be aggressive, to go on a reversal, because we can spot the reversal right over here with indicators from best order flow, delta 2, delta 1 indicators, footprint indicators. and the market speed indicators, we can spot this reversal easily. And when we enter it in this area, or maybe in this area, when the price retested over here or retested right over here, we can collect all of this movement from here to going at least to the previous local high. And this can be our first target to exit.